Is it possible to know in advance just how risky an investment might be? In general, stocks are riskier than bonds and cash, and accordingly, portfolios with a larger investment in stocks are riskier than those invested more in bonds and cash. But what if two portfolios have the same percentage of stock, but very different kinds? How do you know which one is riskier? By comparing their standard deviations. This video will help you understand what standard deviation is and how to use it when assessing the amount of risk you are taking with your investments. Let's look at 3 different portfolios, each of which has grown 8%, compounded annually, over the past 36 months. Despite each achieving the same amount of growth, they all had markedly different monthly rates of return during that time. Portfolio number 1 experienced relatively little volatility compared to that of portfolio number 3, while number 2 fell somewhere in the middle. By simply looking at these graphs, you can tell which portfolio was more or less risky than the others. Unfortunately, you seldom have charts like these available for portfolios you might be considering. However, what you will often find is a standard deviation calculation, a number that mathematically expresses the month-to-month volatility of a portfolio's return. This will give you the same information at a glance that a graph will give you. Simply remember, the lower the standard deviation number, the less risky. One more important fact to remember. Standard deviation is a calculation based on historical data. Past performance of an investment is not a guarantee of its future performance. The future return and volatility of an investment can differ greatly from its historic performance. However, equipped with your knowledge of standard deviation, you now have one more tool to make the best investment decision possible.